Stablecoins have been the best guard against the volatility of the crypto bear markets. They are supposed to be a safe haven asset, but some do implode from time to time. In this video, we'll walk through some of the basics of understanding the different types of stablecoins and give you the confidence to understand which ones to choose and which ones to shun. But first, hit the like button, subscribe to the channel for daily crypto news updates and explainer videos just like this one. Let's get into it. Cryptocurrencies come in a few different categories. One of them is the stablecoin. Stablecoins are a cryptocurrency that intends on holding a specific price in order to achieve stability. Stablecoins are designed to be pegged one-to-one to a fiat currency, a government-issued currency, or other assets such as a basket of cryptocurrencies. The introduction of stablecoins finally allowed crypto users to hold something with a stable price in the crypto ecosystem. This allows people to protect themselves against the volatility of the market. The growth of the decentralized finance field has propelled stablecoin research forward, and now there are a few different designs of stablecoins, which I'll share with you in this video. Let's have a look at the first stablecoin, Tether. The first type of stablecoin is a fiat-backed stablecoin exemplified in Tether. Tether was the first stablecoin project to launch and is the most widely adopted stablecoin in the world. Originating in 2014, Tether Limited is owned by the Hong Kong-based company iFinex Inc., which also owns Bitfinex crypto exchange. Tether claims to be 100% backed and fully transparent. It intends to hold all United States dollars in reserve so that it can meet customer withdrawals upon demand. They claim to make reserve account holdings transparent by external auditors to deliver quarterly reserve reports. So at large, Tether has been a very successful stablecoin and inspired many offshoots that are in use today, like BUSD, the Binance stablecoin, and Circle's USDC. These are the most widely used fiat-backed stablecoins. They aren't without their troubles though. Each has lost their peg slightly from time to time, but they've always managed to regain the one-to-one ratio. The tokenomics behind what makes these cryptocurrencies work is very young, and it should still be considered pretty high risk. Some of the most well-known and highly used stablecoins in the crypto space come from well-established exchanges. According to CoinMarketCap.com, in terms of 24-hour volume, which would indicate which stablecoins are most transacted, USDT Tether is at the top and touts the most volume by far at $50 billion. It's followed by BUSD, which is the Binance stablecoin at $10 billion, shortly after by USDC, which is the stablecoin from Circle, and the decentralized stablecoin DAI from MakerDAO. These most used stablecoins are all fiat-backed, excluding DAI, which is crypto-backed. There is an interesting risk trade-off here. The more decentralized we get, the higher the risk because there's less of the control mechanisms of the traditional fiat economy. Stablecoin growth month to month has been increasing significantly since 2020. Recently in August, it hit an all-time high during this crypto bear market. It just goes to show that the crypto economy is growing even though the market is uncertain and prices are volatile. These stablecoins are increasing in usage. Much like spinning up a successful blockchain and the blockchain trilemma, a successful stablecoin project is one that adequately solves the stablecoin trilemma. That is, a good stablecoin has to juggle the trade-offs between price stability, capital efficiency, and decentralization. Usually, a specialization in one area will compromise one of the other areas, hence the trilemma. Price stability can be achieved through different price stability mechanisms. Often the issuer of the stablecoin asks for collateral that could be either real fiat currencies or digital assets. The lower the achieved volatility of the stablecoin, the better it fulfills its purpose. The volatility will be low when the stablecoin is highly collateralized, that is, when there is at least one-to-one fiat for stablecoin issued. If it is over-collateralized, the volatility will likely be lower, but the capital efficiency will be off. The capital efficiency describes how much value is needed to create one unit of the issued stablecoin. High capital efficiency is needed to scale the demand and thus the supply of the stablecoin. If, for instance, more capital than $1 is needed to create one unit of the USD-pegged stablecoin, the stablecoin design would be described as capital inefficient. If less than $1 is needed, the system can be considered capital efficient to enable growth. The growth can also help to stabilize the system, making capital efficiency a strong demanded characteristic. Decentralization is the third dimension of the trilemma and plays a crucial role in any token and protocol design. Stablecoins have become an important and integral part of the DeFi economy and the wider Web3 ecosystem. Thus, decentralization of the governance and the systems of stablecoin issuers help to mitigate centralized single points of failure and risks. Stablecoin issuers aim to follow the properties of the base layer. Thus, they aim for censorship resistance and transparency and need to be permissionless through decentralization. So here are the three different types of stablecoins. First, we have fiat-backed. Fiat-backed cryptocurrencies are very reliable and the safest option while we are developing more decentralized versions. However, the trade-off is this. The requirement to hold actual fiat currencies such as USD or AUD can only be met with the existence of fiat-compatible bank accounts. Thus, fiat-backed stablecoin issuers rely on a centralized structure with regulated entities and the traditional financial system. This leads to low transparency with stablecoin issuers and a high need for trust by investors and stablecoin users. Second, we have crypto-backed. Crypto-backed stablecoins are the answer to the shortcomings and trade-offs of centralized fiat-backed stablecoins. Trustless systems and decentralization are the main pillars of the crypto ecosystem, and thus the creation of decentralized on-chain stablecoin protocols was inevitable. This type of stablecoin is backed by other digital assets such as BTC, ETH, other tokens, or any tokenized asset. It's usually created through decentralized protocols to issue and redeem the tokens. Thereby, digital assets are locked as collateral in smart contracts to issue or mint new stablecoins. One prominent example of a crypto-backed stablecoin is DAI from MakerDAO. Due to the open source approach of the on-chain stablecoin protocols, this space has seen rapid innovation and growing competition. Stablecoin protocols are usually governed in a decentralized way, often by a DAO based on a governance token of the protocol. Although decentralized governance creates censorship resistance to a certain degree, operations and decision-making processes are slow and tend to be inefficient. Further, on-chain protocols can only accept crypto assets as collateral. Thus, the collateral is subject to higher volatility compared to fiat currencies as backing. This leads to the fact that most crypto-backed stablecoins are over-collateralized to account for the volatility of the collateral and ensure that the outstanding stablecoin supply is always backed and redeemable for $1 in value. To lower the required collateralization ratio without compromising on price stability, some stablecoin protocols accept other stablecoins with deep liquidity, such as USDC, as on-chain collateral. Thus, the collateral has low volatility, reducing the risk of a significant drop in value. DAI and Frax are good examples of this. However, critics argue that by heavily relying on centralized stablecoins as collateral, the decentralized protocols expose themselves to the same censorship risks that they were trying to mitigate. The third type of stablecoin design is the algorithmic stablecoins. Algorithmic stablecoins have been a promising solution to solve the stablecoin trilemma for a long time. Instead of relying on fiat-backed or over-collateralizing crypto-backed, algorithmic stablecoins have implemented an algorithm balancing the supply and the demand of the stablecoin to maintain price stability. The mechanisms do not rely on traditional off-chain or on-chain collateral. Instead, the stablecoin is secured by the value of a second token. Usually, an algorithm balances a two-token model with a mint and burn mechanism for the second price floating token. The protocol ensures that investors can always swap one stablecoin for $1 of the price floating token. Arbitrageurs are incentivized to buy the stablecoin on the market and exchange it for the price floating token if it's trading below the peg, and vice versa. If investors want to swap their stablecoins, the protocol mints a new price floating token while the supply of the stablecoin contracts. Here's an example of an algorithmic stablecoin that went wrong. The case of USDT. Algorithmic stablecoins have been the first category to achieve capital efficiency. Critics argue that algorithmic stablecoins create value out of thin air and can only survive as long as the trust in its algorithm and the value of the corresponding risk-absorbing token are strong enough to manage the demand and supply. The events around the crash of USDT from the Luna Foundation Guard and its Luna token have proven the extraordinary risks associated with algorithmic stablecoins. Highly solvent market agents have attacked the peg of UST by heavily dumping UST on the market. If such an attack is only for a short duration, the algorithm will balance the supply and demand and bring stablecoin back to the USD peg. In the case of UST, the well-capitalized attack was coordinated in times of big market uncertainty, and investors increasingly lost their trust in UST. This led to a so-called death spiral in which more and more Luna tokens had to be minted to support the UST price and thus heavily inflating the Luna price. The lost trust through a further dropping UST price led to more and more people trying to exit the coin. The Luna Foundation Guard tried to stabilize the price of UST through the use of its crypto reserves, but that was just a drop in the ocean. If you like this explainer video, hit the like button and subscribe for more videos just like this one. That's all for this explainer. I'll see you next time.